Senator Warren.
Thank you, Mr. Chairman. Thank you, Ranking Member Crapo, for having this hearing. And I particularly want to welcome Mr. Goodman. Thank you. I'm glad you're here from Massachusetts. I understand you're from Hull. And so welcome, and thanks for your work with the Association of Institutional Investors. It's really important work. So I want to ask a question about counter-cyclicality. You know, we've seen that the housing market is naturally pro-cyclical, that when things are going well, lending becomes overextended, and when things are going poorly, lending decreases dramatically. So I believe it's important for regulators to have the authority to exert counter-cyclical pressure on the housing market. Peaks won't be so high, but the valleys won't be so low, and that reduces the risk of a future taxpayer bailout. So one way to exert countercyclical pressure is to raise government guarantee fees during boom periods and lower them during declines in the market. But that won't work unless the regulators have authority to exert countercyclical pressure on the private label market as well. Otherwise, when guarantee fees go up during the boom period, it'll just drive everyone over to the private label market. So my concern is how regulators can exert countercyclical pressure on the private label market. Professor Levitin, could you weigh in on that?
Sure. There is a tool missing in the regulatory toolbox. And that is that regulators do not have the ability to control the amount of leverage in the housing finance market. In other words, what regulators need to have, the tool regulators need to have is the ability to limit combined loan to value on new mortgages being originated at any point in time. So regulators can affect the housing market by interest rates, but that affects more, that's a blunderbuss. It's not a surgical tool for the housing market. It affects other markets. Controlling loan-to-value limits, if you gave it to a regulator, I'm not sure which, but let's say the Federal Reserve, that would give them a targeted tool for dealing with overheating of the housing finance market. And this is something that's actually done outside of the United States in some countries. Hong Kong, it's a small market, but Hong Kong does this. Canada and Spain have systems that get to a similar result, even though it's not formally through LTV limits that apply to originators.
Yeah. So let me just ask, Mr. Hughes, do you agree, as an issuer of private label securities, that the government should address the inherently pro-cyclical nature of private label housing finance market?
I would agree.
And would you agree with Professor Levitin's suggestion of a tool doing it by regulation of loan-to-value ratios, or would you do it a different way?
I think loan-to-value ratios are important. They've been overlooked in QM or QRM. I think, you know, what investors look at from an investor side, the most important criteria in determining whether there's a risk of default is the amount of equity in the property. Yes, I think that would be one important way of...
So you'd support some regulation in this area?
Correct.
And Mr. Kidman, would you like to weigh in on that?
I agree with your observation completely. The GSEs or the federal government play an important role in housing finance to provide that counter-cyclical capability. I think QM and the LTV ratios have been discussed as a key component, but another one could be, in terms of levers that are available to the federal government, is capital ratios with the originators.
Got it.
But there are tools, there are mechanisms, and what we don't want to happen is for GSE reform to be pro-cyclical rather than provide the backstop that's necessary in times of crisis.
Right. Thank you very much. Let me ask one other question. You know, even if the private label market represents only 20% ultimately of the overall housing market, it still would be a multi-trillion-dollar market that it's dealing with. And given the size and importance of the market, I worry that there will still be an implicit government guarantee that will affect the risks taken on by private actors. So I hear from a lot of people that the new QM and QRM rules, along with the SEC's eventual revisions to Regulation AB, will adequately limit the risk that can be taken on by participants in the private market. Professor Levitin, do you agree with that?
I'm not sure, but I have concerns. We don't know exactly what the final QRM rule will look like, much less Reg AB, which seems much less advanced in its promulgation. To the extent that loans are QM, it will significantly limit market risk by ensuring the borrowers have the ability to make monthly payments, but there's not an LTV component to QM as noted. What makes me skeptical here is that I think that a fair amount of the market eventually will not be QM. My impression is that a lot of the financial services industry does not fully understand the QM and the consequences of a mortgage not being QM. There's actually a fairly weak remedy provision. If a mortgage is underwritten without ability to repay, I guess it's not underwritten in that sense, and it doesn't happen to meet the QM safe harbor, there's no penalty just for that. There has to also be a default on the mortgage. There has to be a foreclosure following that default. The homeowner is going to have to be willing to litigate the foreclosure. So we're talking about really a very small number of cases. And then if that happens, the homeowner has a defense in the way of set-off against the amount of money owed, but it's actually a very small set-off by statute. I think there's some interpretive room in the statute, but I think in most cases, we're probably talking basically about set-off of attorney's fees plus $4,000. That's not a lot. There really is not much risk from a mortgage not being QM. I think once the market understands that, a lot of mortgages won't be QM.
All right. Well, I'm very concerned about this, but I see that I'm over my time, so I very much want to hear from the others. I'll submit questions for the record. Thank you, Mr. Chairman.